Wanted to say hi to everyone. Thank you very much for joining. Welcome to our webinar on qualified small business stock and what business owners, founders, and their advisors should know. Before we jump in, I want to introduce myself and our panelists. My name is Mike Delgass. I'm a managing director here at Wellspire Advisors. I am, as they say, a recovering tax attorney and an advisor with a special focus on clients with closely held and family businesses. And as an advisor focused on those kinds of businesses, my clients have a tremendous opportunity to save taxes when they understand QSBS planning. So I'm really pleased to be joined by two of my colleagues and resident experts on QSBS, Liz Summers and Kevin Brady. Liz serves as our Director of Wealth Strategy. Liz began her career as a practicing trust and estates attorney, but now is part of our Wellspire team, bringing deep expertise in estate planning, philanthropy, and business succession planning. Thanks for joining us today, Liz.
Thanks.
Our next panelist is Kevin Brady. Kevin is a senior vice president and advisor in our New York City office. He works closely with successful business professionals, entrepreneurs, attorneys, and small business owners. Kevin is a frequent contributor to industry publications like CNBC, Financial Planning, Market Watch, Bloomberg, et cetera, lots of good stuff from Kevin. Thanks for joining today, Kevin.
Excited to be here.
So thank you both for joining us. Both Liz and Kevin have been guests on our podcast series called the Business Owner Bootcamp, as well as both having contributed to many blogs and other writings around QSBS. So please be sure to check them both out there as well. There's lots of good content from them on QSBS and other things on our website. So be sure to visit that and get the full scoop there if you want to dig further into any of these questions or related ones. But before we get started, I want to do some housekeeping. If you have a question during our presentation, please use the Q&A function at the bottom of your screen. You're going to see a little button there. And if we don't get to your question during the session, we will follow up with you. So we want to make sure that we're answering questions. The things you guys are interested in are really the most important to us. So we will figure out a way to get those questions answered. This call is also being recorded, so we'll distribute that recording and presentation a few days from today. But now, let's get started with what we're here to talk about, one of the most powerful but underutilized tax planning tools, QSBS, and why it matters more than ever post-OBA, which is a big legislative package that was passed not too long ago this summer. So we're going to see how OBA has expanded this opportunity, but I'm going to speak for everybody here. We're still shocked at how little people know about it, and that applies not just to clients, but sometimes legal advisors, accountants, that kind of thing. This is something that is huge in terms of potential tax savings. When I say huge, I want to kind of level set here. We're talking hundreds of millions of dollars of potential capital gain exclusion. And this is not a tax deferral. This is you never pay tax on an enormous gain if you sell a closely held business that you're a founder of. And we'll talk more about the details, of course, there and how you get to those numbers and how long you have to hold and stuff like that. But as we go into this discussion, keep that in mind, that this is one of the biggest tax opportunities that you will ever see if you are a family business owner, closely held business owner. And so we think it's really important that we educate our clients and make sure they know going in that there are some things that they can do to try to take advantage of that. So, Kevin, let me start with you. Why don't you help us just get oriented? So, what is QSBS Section 1202? What's going on here?
Thanks, Mike. So you underscore the importance of this very, very well. I would simply just triple down on that and say, just to set the frame even more here, there's a lot of tax deferral uh, strategies in the IRC and the Internal Revenue Code. There's very few like this where you can literally exclude tens of millions to hundreds of millions of dollars of tax. So that's why we're all here today. That's why we all are speaking about this. So with that said, I'm going to preface this by saying there were some significant changes on July 4th with the passage of the One Big Beautiful Bill Act. So I'll try to simplify this by talking about what the rules are, what the benefit is prior to that bill, and then we'll get to the changes thereafter. So simply put, QSBS lets you, an investor who holds the shares, exclude the greater of $10 million or 10 times your adjusted cost basis. Those last
And
three words,
I
very
want to
important.
emphasize one thing you said before we get too deep. You're giving us pre-OBA, right?
Yep,
So this is what the rules used to be, and we're going to talk about how they changed and why that's so important. So, sorry, go ahead, Kevin.
that's right. So everything I just described, or at least the $10 million number, that's stock issue July 4th, 2025 or before, which let still important to make that distinction because many people will have those types of shares. Um, there's there's a number of requirements, both for shareholders themselves. Those are pretty straightforward, and some corporate requirements, which are where the rubber meets the road, a little trickier to
Mm.
meet. And Mike, you'll let me know if we want to dive into those as a broad overview. Happy to do that.
Well, I want to follow up on one thing you said. When you talk about stock issuance prior to a certain date, maybe we should talk a little bit about the corporate requirements, C status, and that kind of stuff, because I think some people figure that, hey, if I had a business, maybe it's not qualified yet because I haven't done a C conversion or anything yet. Maybe I'm under the old rules and not the new rules. And I think often that won't be the case. You'll get the new rules. But let's start at the beginning. Just give us the qualifications and then tell us how OBA changed the exclusion.
Yep. Qualifications for the shareholder are the easiest ones to remember. So we'll start there. You can't be a C corp, the actual owner of the share. So you got to be individual, a trust, a pass-through entity. Pretty simple. You have to get an original issuance, so you can't have purchased them from someone else. Gifts and bequests are important exclusions to that general rule. And you have to, under the old rules, have held it at least 5 years. That's what has changed. We'll get to that. There's a shorter partial holding period that now exists. Shifting to the corporate side, few of the important rules. You have to be a C corp, which Mike you alluded to.
Mhm.
If you're not a C corp at this point, that doesn't mean all is lost. There are steps you can take to start the clock, to start that 5 year clock or shorter period. You have to be what's called a qualified small business, as the IRS defines it. It's essentially an exclusionary test. Uh, Put simply, you can't be a service business, something that depends on the skill of the founders themselves or
Right.
key employees. So, hospitality is carved out, real estate, banking, financial advisors, accountants. Insert, service business. That's generally a no go.
Law firms. Yeah.
Law firms, exactly. So all the attorneys that we work with, they're not going to qualify for this sort of provision. Um, and the last few, you have to use 80% of your assets towards the purpose of that qualified trader business. The details of how you meet that are a little wonky, but just keep that in mind, 80%. And the last one, also one that changed, is you have to have gross assets below $50 million before immediately after these shares were issued. So typically startups, this is big in Silicon Valley for that reason, angel investing and up to Series A. But as we'll go through, there's also a big opportunity for family-owned businesses, existing S corps that could convert and meet that $50 million threshold. So I'll pause
Right.
there and we can go
So
back.
pre-OBA, we had a $10 million exclusion or 10 times your basis if you had an asset threshold, if you met the asset threshold test of 50 million or less, and you held the stock for at least 5 years. When we say the stock, what we're talking about is the stock of the C corporation. So if you were, for example, an S corporation and you converted to C, that's when the clock starts. So you reset your entire holding period. Now you have to wait, but The good news is now you're the founder of that. So you received that. So regardless of how you got the S corporation shares, if you got the C corporation shares as founder at original issuance, you're good. But that's old rule. New rule now post OBA is, Kevin?
Yeah. Three main changes, and they're all for the positive that happened with OVA, were the exclusion went from 10 to $15 million. And
Yay.
that's yeah, that's
Yeah,
big. You
yeah,
still have that 10 times adjusted basis, the greater of those two things, so keep that in mind. The gross asset test increased from 50 million to 75, so the
yay again.
threshold you can meet
Yeah.
higher hadn't been increased since 1993, so that's a welcome change.
Hmm.
And I'm leaving the last, but certainly not the least significant change is there are now partial holding periods of 3 years and 4 years that qualify you for 50%, 75% of the exclusion, respectively. So I will steal Mike's thunder, which I'm sure he wants to expand upon how big of a deal that is. 3 years is huge. That's, doing math quickly in my head, that's a 40% reduction of the time you have to hold to get some sort of significant benefit, depending on your scenario and situation. That's a big deal. That's huge.
Right, right. And if you are starting to think about selling but haven't gotten started yet, and you do your C Corp conversion now, um, you could easily be into 3 years by the time you are ready to close on your sale, or maybe even farther than that, because you are looking around for an investment banker, you're doing quality of earnings studies, you're maybe getting audited financials. So you're moving things around, you're changing a little bit, your structure maybe even, you're kind of cleaning things up. That's going to take months and months. And before you know it, you could be at that 3 year period when you're ready to actually close on your transaction. And you know, people worry about being a C corporation because of the double taxation. That may or may not be a downside depending on how you're administering the company and what you're distributing and stuff like that. I don't think we want to get too deep into that. But if you're only doing it for 3 years, that's not a very big penalty if it is one at all. And I want to go back to one thing you said, Kevin. You said adjusted basis. That adjusted is really important. Um, if you just think of the 75 million asset test for the company, now that asset test isn't exactly the same as fair market value, but let's say for a second it is 10 times your adjusted basis, where the adjusted basis is the value of the company. 10 times, check my math, but I'm pretty sure this is pretty easy. 10 times 75 million is $750 million worth of capital gain exclusion. So when we talk about there are hundreds of millions of dollars potentially out there to be had as exclusion, that's what we're talking about. But I want to turn to Liz and help us understand a little bit about how ownership structure works here and what the issues are. The one really cool thing is that there's no family attribution rule in QSBS really. So that means that people like Liz can do lots of cool stuff for us, and maybe even some of that stuff is there already if we think about it in the right way. So Liz, let me turn to you. What are the strategies here that we ought to be thinking about in the QSBS context and maybe writ larger too for business owners?
Sure. Absolutely. Just to start, from 10,000 feet for every business owner, we want you to have a good core plan, board of will, rev trust, power of attorney, healthcare directive. You have to pardon me, I'm in a morbid business. This is the plan that comes into play if you're hit by the bus tomorrow. So that's the plan that's going to provide some privacy for your estate, take care of your surviving spouse, preserve any exemptions, all of that good stuff. And if you're a business owner, it's especially important because to the extent that you haven't transferred your business before death or made arrangements through a buy-sell or other means, this is going to govern who's going to step into your shoes for purposes of making decisions for your business. So core plan is super important for business continuity. Um, That's sort of bucket one. Bucket two is where things get a little bit more exciting, at least for people like me. That's where we get into what I think of as kind of the alphabet soup of estate planning. Making use of our lifetime exemption, which is 13.99 million per person this year, scheduled to go up to 15 million next year, indexed for inflation. And that number is permanent as far as we can say that any tax law is permanent. That's what we're
Right.
going to be working with going forward. So we can make use of that exemption while we're still alive. And a good rule of thumb for everyone, regardless of whether or not they're a business owner, is it generally makes sense to take advantage of that gift exemption and move assets out of our taxable estate sooner rather than later, so that appreciation takes place outside. When we're utilizing irrevocable trusts, which is a big part of this planning, we also want to make sure we're working with our counsel to draft trusts that aren't just creditor protected, don't just use our exemptions in a wise way, but are also flexible because these are trusts that are designed to last for a very long time. We might know our kids, we might even know our grandkids, but we don't know our great-great-grandkids yet, and we don't know what their needs will be. So, keeping all of that in mind, generally, big picture, we're thinking about gifting non-voting interests in our business to an irrevocable trust, right? And the reason we do that, why we keep it non-voting, is first of all, I'm sure there's no one watching right now who likes to be in control, right? So when we carve off our economic interest of a share in our business from our control interest, we're basically allowing the trustee and the beneficiaries of that trust to take advantage of all of the joy of upside for that share of stock while maintaining control in our own hands. The other big advantage here, of course, is if I walked up to you on the street and I said, how would you like to buy a share of Apple? You could look at your phone in 3 seconds, you know what the value is and if the price I'm offering is fair. With a closely held business, it's an entirely different ballgame. So we need to get an appraiser involved to determine what the actual fair market value of a share in our business is. And in addition, if that's a non-voting share, we might be able to take certain discounts
Mhm.
off of that value. So using this sort of strategy, let's say just for big ballpark numbers, if we have $10 million worth of non-voting shares and we have that appraised, and due to lack of control, lack of marketability, the restrictions we place on those shares, the fair market value of those shares is 7 million. We can utilize 7 million of gift tax exemption to transfer 10 million of value. And if those shares subsequently sell, let's say 5 years down the line and they're worth 15, that whole 15 million is outside of our taxable estate. So all of that appreciation has been sheltered. Things get especially interesting with business owners when we're thinking about a sale, right?
Mhm.
So this is why Kevin and Mike and I really want you to come see us sooner rather than later. There are some strategies in our toolbox that really require a longer runway. QSBS, of course, our star today being one of those. We're really benefiting from that tiered system, which is excellent. So we can get some benefits starting at 3 years. But if we want the full 100% exclusion, we need at least 5 years of runway if we're starting with, say, a conversion, right? So keeping all of that in mind, we want to plan earlier, even if we're not doing QSBS, because we've got this sort of murkiness around the value of our share for a long time.
Mhm.
We're a closely held business. But once we have an offer in place, once we have a binding letter of intent, effectively the market has spoken, right? There's a new clear fair market
Right.
value for this asset. And there might still be a little bit of wiggle room between that binding letter of intent and close, simply because not all deals close. But in general, the sooner we can move those assets, transfer them at a lower value at an earlier point in the life cycle of the business, the better off we're going to be. And simply, things get a little bit more complicated and a little bit more interesting, again, at least to me, when it comes to QSBS, because we have to do some different things when it comes to structuring trust than we normally do. So one very, very common strategy when it comes to wealth transfer, you probably heard all about it, is our word of the day, our favorite word really is grantor trusts. We love a grantor trust in estate planning. They're fantastic. So there are really two types of trusts for purposes of our discussion today for income tax purposes. There are grantor trusts and non-grantor trusts. Our grantor trusts, which again are very common, the advantage there is that the income and estate tax rules overlap, but not completely. There are some
Mhm.
gaps. And we make really clever use of those gaps. And with a grantor trust, which is a term of art because every trust has a grantor, but only some trusts are grantor trusts. But with a grantor trust, you remain the owner of the assets in that trust for income tax purposes, but they are out of your estate for estate tax purposes. And any appreciation is also out of your estate for estate tax purposes. Uh,
I think that's a really important point I want to emphasize. I mean, this is not gray, right? There are revenue rulings on this. The IRS has regulations that literally say that you can use the grantor's social security number for
yeah,
the trust. That's how tight this is. A grantor trust is the grantor for all income tax purposes, not for estate and gift, but all income tax purposes. And that's the world we're in right now when we're talking about QSBS. So sorry, let's go ahead.
no, love it. Great point, Mike. You can report under your own social security number, and because you are the trust and the trust is you, you can sell assets to that trust without it being a recognition event. There might be a completed gift when you make that transfer into the trust for gift tax purposes, but for income tax purposes, you can't make a gift to yourself, right? So effectively, nothing has occurred until a little bit later down the line, potentially. So we love our grantor trusts. They're very flexible. We pay the income tax on that trust, which is a really big deal. I usually get the question, why would I want to pay income tax on a trust I can't benefit from, assets I no longer own? And the reason is the payment of that tax on behalf of the trust is not an additional gift to the trust. And this is huge because that means that grantor trust, those assets grow and appreciate effectively tax-free as long as it's grantor trust.
Mhm.
So that includes any distributions to beneficiaries. You know, the trust doesn't have to consume its own assets to pay tax. It also draws down your taxable estate when you pay that tax on behalf of the trust, which is a nice side benefit, although, you know, sometimes we have to brace ourselves to pay that extra tax. Keeping all of that in mind, we love grantor trusts, but they're not perfect for every specific use case, and they're not really perfect for QSBS. And that's because, again, remember that core concept of you are the trust and the trust is you? Each individual has their own QSBS exemption of that 15 million or up to 10 times gain, right? Going forward. If you're the trust and you set up, say, a spousal lifetime access trust and you set up a dynasty trust for your kids and they're both grantor trusts, you and your two trusts all together, you only have one exemption. That's it.
Right.
So where we get into some really interesting territory is unlike a grantor trust, a non-grantor trust is its own taxpayer from the jump.
Right.
Files its own return, it has its own taxpayer ID, it has its own exclusion for QSBS purposes. So if we want to start in the world of non-grantor trusts as opposed to grantor trusts like we often do, we can make use of our gift exemption, fund these trusts, and ideally, again, doing this well in advance of the sale so our value is low and our gift tax use exemption is low. When that pops, each of those trusts, those non-grantor trusts, has its own exclusion. We do have to be careful. There are some rules around that. I think it's IRC 643F wants to make sure that these trusts aren't exactly identical, or the IRS could say, you know, this is abusive. I don't like this.
Mhm.
But as long as we take care to make sure that we have, you know, different grantor, different beneficiary as we may need, we can pursue a strategy known as stacking, where we have multiple trusts with multiple exclusions. Um, so
Let
I
me let me just kind of flesh that out a little bit. So, you know, married couple, and they've got you know, two children, let's say,
yeah,
right? So we go from 15 million because we only have one person, or maybe we have one person and a bunch of grantor trusts, to I count four, right? That is four family members. Seems like we
mhm.
could do at least four times 15, and then maybe we could kind of mix and match too, right? I mean, what can we
There's
do
a lot
here?
of opportunity here
Yeah.
for sure. Again, it really depends on us sort of being thoughtful. And with non-grantor trusts, remember with grantor trusts, we said you could sell assets into the trust without it being a recognition event. That's not true with a non-grantor trust. So we are in many ways a little bit hamstrung by the top
Right.
of our gift tax exemption. Fortunately for all involved, it's at a historic high. as we discussed a little bit earlier. But if we did try to sell QSBS into a non-grantor trust to get even more in there, that sale would violate the original issuance requirements. So we would no
Right.
longer have QSBS treatment.
Right.
Unfortunate.
Right.
Another thing I always want to add is if we've used up all of our exemption, we're at the limit of our authority when it comes to non-grantor trusts, we might want to investigate potentially an incomplete gift non-grantor trust, or an ING. In the acronym parlance of estate planning, you might hear it referred to as a DING, or Delaware Incomplete Non-Grantor Trust, or a WING for Wyoming.
Or a ting, Tennessee.
TING, Tennessee. We love Tennessee here. Always, we get out of control here sometimes when it comes to the acronyms. But again, because this is not a completed gift, we're not using up gift tax exemption, but because it is a non-grantor trust, that trust is eligible for its own exemption, or exclusion rather, for QSBS purposes. So we can, there are a number of roads to Rome here.
And look, if this doesn't make sense, if it's not intuitive because it seems like it's not matching, that's the point, right?
Yes.
The income tax stuff and the gift and estate tax stuff, as Liz said, they do overlap quite a bit, but it's just not perfect. And it's in the middle, in the empty areas in there, you can kind of play around and stuff. But for people who've done a bunch of planning already, that they've probably done that with grantor trusts and stuff like that. Is that a good or a bad thing? Like, am I kind of out of luck, or can I change them to non-grantor trusts if I'm trying to do my QSBS stacking? How do I do this?
Oh, fortunately, we're not out of luck at all. We might need to do a little bit of additional legwork, which is important. It's not uncommon that people come to us having done some planning before they discovered the magic of QSBS status, right? And they've done some sophisticated work. They've put assets into these grantor trusts. They've used their exemption. We're very proud of them. But, there's a little bit more that we can do. So the thing to keep in mind is that we can convert a grantor trust into a non-grantor trust. And the way we do that really focuses in on what makes something a grantor trust. There are a couple of things that can do that. You look to the grantor trust rules of IRC 671 through 679. There are a couple of things that we commonly see. And typically, I would say most common, it's that we hold a couple of specific powers ourselves as grantor, or our spouse is a permissible beneficiary of this trust, right? Or frequently both. So if we set up a trust, let's say for our children, our spouse isn't a beneficiary, kids are beneficiaries, and we hold one of those very common powers that makes the trust a grantor trust, like a swap power, which means that we can exchange assets that we own for assets of equivalent value owned by the trust, which can be very useful for basis planning later on down the line. What we could do is we could irrevocably release that power. We say, I'm letting it go. I release it. I sign a document. That, and again, any other powers that make it a grantor trust, we let them go. It's now a non-grantor trust. We need to get it its own tax ID. It needs to start filing its own returns. If it owns QSBS, for income tax purposes, that's when the gift occurs. The transfer from the grantor trust to the non-grantor trust, because it finally moved to a different taxpayer, right? So keeping that in mind, that's all well and good. That's relatively speaking, as these things go, I'm going to say easy. It's a very complicated area. But things get a little bit more complex when we have what I'm going to say is, again, really the star of the past few years. I'm going to say the past decade or so. I think of it as the era of the SLAT, right? Spousal Lifetime Access Trust. They're very, very common and for a very good reason. As long as you have a SLAT, you can maintain indirect access to those assets that you gifted through your spouse, as long as you have the good sense to stay on good terms with them, right? So
For a lot of good reasons.
for
Yeah,
a
not
lot
just
of
tax related. Right.
So that's all well and good. But the thing is, when it comes to sort of changing the status of a grantor trust, flipping it from a grantor to a non-grantor, unlike those powers that make something a grantor trust, having a spouse as a beneficiary isn't a power that we hold. It's not something that we can just go ahead and release. It's not something personal to us. It's embedded in the trust agreement. And what that means is if we want to convert, I'm so sorry about this, our SLAT to a SLANT, or Spousal Lifetime Access Non-Grantor Trust, We need to modify the trust agreement itself. And there are a number of ways to do that. We can work with, of course, we're always working with local counsel because each state has its own law, and we want to make sure we are doing, finding our best road to Rome, so to speak. That might be through a trust protector if the trust has one. It could be through a court modification, decanting, non-judicial settlement agreement, lots of ways to kind of get to that goal. But what we have to do, and this is can be a very sensitive point, is to convert a slat to a slant. What we need is an adverse party who signs off on distributions to our spouse, right? And when we say adverse party, that's a term of art in this particular area, and it means someone who is also a beneficiary of the trust who would be adversely affected if your spouse received that distribution. So typically what that means is it's a child. It's another beneficiary of the trust. And as anyone who's worked with a CUPERT knows, it can sometimes be sensitive when we're suddenly looking to our kids to sign off on what we get to use and when, right?
Right.
So I would just put that little caution in place.
Liz, I want to make sure we have enough time for questions at the end, and I also want to ask Kevin a bit on packing. The adverse party stuff is really interesting, but I think the big takeaway for clients is don't give up, right? If you've done a bunch of great estate and gift tax planning, there are still things you can do to create that non-grantor trust, no matter who is the beneficiary. And if you don't have kids, parents are potential ways of getting an adverse party in there. There are a lot of different techniques here to figure this out. So there, we need to kick tires and kind of unpeel things to see where the opportunities are. Um, we do have some questions. I'm going to get to those, I promise. Keep them coming. But before we do that, Kevin, Liz was talking about stacking a bit here and kind of adding additional taxpayers, right? Because again, there's no family attribution, so we can do that. It doesn't matter that they're all related. But stacking and packing are kind of the two cool buzzwords that people throw around when they talk about QSBS planning. And just so that we're being complete here, what's the other part of that? We talked about stacking. What's packing?
Right. Before I promise I'll be quick with this, I did want to address while we're on stacking and that concept, it comes up the state rules of what QSBS, what states follow it, what do not. I'll very quickly just give a nod to that. Each state essentially has three choices. They can fully conform to what the IRS has done, the federal government. They can partially conform, or they cannot conform at all, or irrelevant because they don't have a state tax at all. The good news is most of them conform or do not have a state tax. There's only a small handful that do not, and they are unfortunately some bigger states. So California, New Jersey, Pennsylvania are your big states where if you live in those states, you're going to have to think there is still planning to be done, but there could be a state tax liability even if you are getting out of the federal.
And to be clear, that's a state income tax liability.
Correct.
There's no E on the front there. We're not talking about estate taxes. We're talking about state taxes. So if you're in Florida or Texas, there's no state income tax and you're not worried about the state level rules.
Right. So shifting to your the original question, Mike, stacking is all about how do we increase the number of $10 to $15 million exclusions that each taxpayer can get. Packing is taking the other side of the greater of $10 million or 10 times basis and try to increase the latter. How do we increase that 10 times adjusted basis number? There are generally two ways to do it, and we've alluded to the first one a number of times. That is exchanging interest in, say, an S corp, or I guess shares in S corp, or interest in a partnership for C corporation shares. So that conversion, if you will, is one method of doing packing on its own, because your value of the business, assuming it qualifies and all that good stuff, that becomes your adjusted basis. So $50 million business, it's an S corp today, you convert it to a C corp, that is now your adjusted basis. 10 times that number is what you would qualify for in my example. So 500 million. The other way, this is more of a eat your have your cake and eat it too kind of scenario. It is a little doesn't always come up, but just to mention it, you can sell both low basis and high basis QSBS shares in the same year. You would use the higher basis shares to increase the adjusted basis of the lower shares that you sold. So it's a way to, again, have your cake and eat it too. I'm trying to think of an easy example to illustrate it. One might be if you have shares that qualify, they've been held for 5 years, but you have shares you were issued 2 years, so that's a partial holding period. You don't meet the 3 to 5 years yet. You could sell all of those shares. The 5 years qualify. That's the only shares would get the gain. The shorter time period for the shares with let's say they have a larger basis, that has the effect of increasing the gain you would be able to exclude for the shares that do qualify. So hopefully that made sense. It's a scenario that doesn't come up often, but
Yeah.
it works.
So on that topic, one of the ways you can set the value, and this is very common in kind of the typical Silicon Valley startup, is you start as a pass through, right? Because you're losing money. You got friends and family money, you got kind of angel investments, seed capital, and stuff like that. But everybody knows you got to scale to actually start making some bucks. So you're going along, you're sending losses out. That's a tax positive to all the people that own it. So you're a pass through. You're not a C corporation yet. And then when you're about to start making money and you're about to go out to the venture world and ask for some real money, big dollars, a Series A maybe or something like that, you will convert to a C corp, and at the time of the conversion, there will be some sale to some other third party to set the value. So your adjusted basis is based on an arm's length transaction that might be with one of the venture capital principals or something like that, so that 10 times that number is kind of in stone now, and we've done some packing with how we've set that number. So could be an appraisal, but an arm's length transaction is one of the best ways to set that number. Okay, so I'll go back and kind of rewind a little bit when we close out here, but I also want to make sure that we answer some questions. And I'll throw this out to both of you, but Kevin, I'll start with you because I think it falls kind of most in your area. So the question is, can a stock lose QSBS treatment if the original stock or company has been acquired by a larger company?
The answer to that is yes. I'll be clear. No, because the stock retains the QSBS character so long as you hold it for the 3 to 5 year period. So
it may also depend, because if it's a tax-free reorganization or something, that acquisition could have been a sale, right? An acquisition sounds like a sale. So if somebody bought the smaller company, okay, that's a sale, and now I either qualified or I didn't. But if it's a tax-free reorganization, then I might still have that kind of carryover status.
Right. I think the genesis of the question is, let's say I'm 2 years in, 3 years into to keep it simple, 5 year holding period. My company gets acquired, merged, sold, whatever the case is. It's a bigger company. That company no longer qualifies. What happens to my shares? They qualified before. What do I do? So long as you hold them for the remainder of the holding period, and all the boxes are checked and T's are crossed, you still qualify for the QSBS exclusion. You're just limited to whatever the gain was at the time of that sale, merger, transaction. So
Right.
That's why I was hedging a little bit my original response.
It's like a lot of the tax world. It depends. It's the answer that you can always give, right?
Yep.
So Liz, we got another question that I think would be in your kind of area. The questioner asks, can we comment about non-QSBS things that happened in OBA, specifically about estate planning or sale of business? And I think you kind of mentioned some of those. Maybe you could kind of remind us of what those big changes were in the estate planning context and that kind of thing.
Sure, absolutely. So the big one, at least again for my little corner of the world, is that we finalized our exemption amount. So we went up
Right.
from 13.9 million all the way up to 15, and that 15 is sort of our permanent threshold going forward. That number is indexed for inflation. And that's not only our gift and estate tax exemption, that's also our generation skipping transfer tax exemption as well. So we're creating really an opportunity to, move generational wealth in a really tax efficient manner under OBA.
So we got another question, and I will describe this as a bit of a ringer because I know who this is coming from. Um, and it's about the step transaction doctrine, and whether that would apply when you're converting from a grantor trust to a non-grantor trust just for QSBS planning. And let me rewind, Liz. I'll throw that at you, but I want to make sure we're all on the same page here first. So the step transaction doctrine is a theory of attack by the IRS, basically, where they say, look, we're going to take all of the steps of a transaction that had no purpose other than tax motivation, and we're going to squish them all together. And we're going to kind of pretend that they didn't happen almost, or kind of try to disqualify you from getting to your end point because you were kind of cheating just because you'd had no reason to do all this other than income taxes. Now, I way oversimplified that. But with that, Liz, why don't take your best shot at that?
Sure. And commentary is welcome, Mike, of course.
Okay.
So I personally, and I am a very paranoid person, given my background, I don't know that step transaction doctrine is the first concern that I have if we're in a situation where long ago we did grantor trust planning with the best of intentions.
Mm.
We really had the goal of using grantor trusts. We were on board, and only later, did it occur to us that QSBS treatment might be an option. Um, it's important that there was no sort of pre-existing plan when we went in with the grantor trust to convert to the non-grantor trust, because of course, if we were doing all of this from the start, we would probably just set up non-grantor trusts for the most part. So for me, in the absence of kind of clear evidence of a pre-existing plan, I'm slightly less concerned about step transaction, but Mike, tell me if I'm not worried enough.
No, I look, you do what you can, right?
Yeah.
And you know, the first rule of law school is like, okay, tell me the rule, but then tell me the sanction, right? Make me care. Um, so okay, I want to know what the rules are, but what what do I not get if I fail, right? If if I wasn't going to get the ability to stack anyway, if I didn't do any of this conversion, at least I'm getting an argument that I accomplished my point, that I actually can stack three or four or however many additional $15 million capital gain exclusions on top of that. That that's worth a lot of money to me, and I might be willing to argue with the IRS about that and maybe reach a settlement on it because millions and millions of dollars is worth hundreds of thousands of legal fees. Now, maybe that's the ex-lawyer in me talking because, at one point I actually got those legal fees. Now I don't. Um, but, I think if it's a defensible, reasonable position to take on a return,
Yeah.
you're not in a penalty fraudulent kind of world. You're just creating an argument, and you may or may not win. But if it's a good enough argument, you may settle someplace in the middle, and that's that could be worth millions of dollars still. So that would be my first observation is just because it's gray doesn't mean you don't try, as long as you're careful about, it can't be fraudulent. There's got to be a reasonable basis, right? All of that stuff. Um, I the conversion from grantor to non-grantor status has real impact besides taxes also. So it's not clear to me that the step transaction applies anyway, but we're getting really deep in the weeds here, I think. And I'd like to kind of make a strategic retreat from being, in a tax argument because this question came from another tax lawyer. I'll say we'll take this offline and talk about it more, but it's an interesting conversation for the tax nerds, which are all of the people on this presenting on the panel right now. So a couple more questions. Kevin, can you talk a bit more about the types of industries that qualify under QSBS treatment?
Yes, and I might be repeating myself here, but it's essentially an exclusionary test, or list that the IRS has. So anything that is a service business depends on the knowledge service of the founders or key employees is going to be excluded. So professions like medicine, law, uh, real estate, anything like that is going to be excluded. So it comes down to if your company makes a product or even a sellable service that isn't this knowledge of the founders themselves. Again, I don't want to get too in the weeds, but there's private letter rulings, district court cases, tax court cases where even in businesses that would be excluded, or industries, I should say, so medicine, law, if it was a service that the company that got the letter was involved in, there are positive outcomes. Look, that's not binding. It's just it's a window and an insight into how the IRS is thinking, referring to private letter rulings. So all that to say, there are excluded industries. It's not as limiting as you would otherwise think at first glance.
And there's also sometimes an opportunity to divide businesses into component industries. So you might have a service element and a technology element, right? So we're selling services, but we've got an app that allows us to do that efficiently. I'm just making stuff up. I'm sure I could, given enough time, I could come up with a better example. But the app sale as part of the transaction might qualify for QSBS and the service part wouldn't. And now the question is, how much value can we jam in to the qualifying piece, and what will the buyer let us do, right? Because it will matter to the buyer also as to how they allocate the total sale price to different businesses and that kind of stuff. And that could be an area of negotiation and that kind of thing. So it it's it's more interesting than it sounds if you just hear, well, services or reputation of the owner or something like that. Okay, you might still have some opportunities, even if you think that most of your business doesn't qualify, maybe some of it does. Liz, someone asks, how many differences in non-grantor trusts are enough, right? So different beneficiary, different trustee, like this is, uh, on the
So,
pigs get fat, hogs get slaughtered rule.
yes,
Where are you
yes,
a hog and where are you a pig here as you're trying to do this?
that's a lovely question.
That wasn't
Um,
addressed to you personally. I just meant
so
in theory.
for purposes of 643F, to the extent that we're concerned about that, the two kind of factors there are, does the trust have the same grantor and primary beneficiaries? And is it designed, is one of the primary purposes of the trust tax avoidance, basically? So I think as long as we have some differentiation between grantor of this trust has beneficiary A, and then a different trust is beneficiary B, just so we're making some space there. As always, when it comes down to slats or slants to avoid the reciprocal trust doctrine, we want to make sure that they're substantively economically different, that the beneficiary's experience of being a beneficiary of that trust is not identical to their spouse's experience as a beneficiary of the other trust. And there are a lot of forms that can take, whether that's, one slat or slant has spouse and children as beneficiaries, and one just has spouse. One has powers of appointment and one does not. Really, it comes down to sort of your counsel's personal level of comfort with what is enough. Some people want as little overlap as possible, and some are comfortable with like, okay, power of appointment, that's a big deal. So I
Yeah.
think that's
Well, and there's even a case that kind of addresses that in the reciprocal trust area. But again, getting into the weeds, I think the most, I was going to say abusive, maybe I shouldn't use that word in a recorded session. It was not a design we came up with, but I saw somebody with exactly the same trustees and beneficiaries, well, at least the same beneficiaries, different trustees, 14 different trusts in 14 different jurisdictions. That was the main difference, in addition to the trustee who was allowing each jurisdiction to kind of be the applicable law. That struck me as a bridge too far, and I wouldn't want to be defending that. Um, but honestly, it worked. Um, you know, they got 14 times back then the 10 million, and so 140 million dollars worth of exclusion.
And
Uh,
I do think, Mike, to your earlier point, as long as you have a solid argument that you feel you're making in good faith, to paraphrase Teddy Roosevelt, there's sometimes value in daring greatly. Make the argument, take the position.
mhm. Yeah, yeah. Um, we got another question that the questioner suggested that it might be an offline question about um, a non-resident alien and how to kind of work through some of the business issues, sales, state income taxes. Great question. Probably not a not exactly a QSBS issue, but a lot of interesting stuff there. So would very much like to follow that up, but we'll do that offline. Um, well, I think that's a good place to stop. I'm not
Yeah.
seeing other
I think there's
questions.
one at the end, Mike. There
Oh,
was
oh,
someone's asking how does the 5 year or 3 to 4 year holding
oh,
period
yeah, okay.
apply if there's additional issuances of stock? If I'm understanding it correctly, the question, each issuance
Ah,
is its own holding period, is the simple
yeah.
answer. So
Yeah, so somebody's asking about a recapitalization of a C corp where you would create additional common and preferred stocks. You're doing additional classes of stock. First, it's got to be common. It can't be preferred stock. So that's part of the rules here. We didn't get into that level of detail. But yeah, the new common stock would have a new holding period. Um, and you'd have to test the asset level also at the time then. Um, but I think that kind of brings up another point that I want to emphasize because I think it's one of the things that's misunderstood. Um, an S corp that converts to a C corp is a different company. It's it, S corp, old co, C corp, new co. You can call them the same thing, but from a tax perspective, you have a different company and you look at the test at that point, at the C conversion. The fact that the brand may stay the same, the copyrights get transferred and everything else, that's an intellectual property thing. That's not a tax thing, right? The fact that you're calling those two companies the same thing, more or less, does not mean that it doesn't work, right? It doesn't mean that you have to kind of go all the way back to the S corporation creation. And that's one of the things that opens this up in the family business world. Even if you're on like second or third generation of ownership, um, if it's still a relatively small company and meets the asset test of $75 million, you can still make this work. And even if it doesn't, you might be able to separate it into different business lines and make some of them qualify and some of them not and stuff. And, at some point you have to make a business decision about whether all the tax restructuring is worth it or not. But ultimately it's at least worth a conversation to see whether you can get any of these big ticket exclusions under your belt if you're thinking of selling. So with that, thank you to our panelists. Liz, Kevin, thank you so much for sharing your expertise with us. We really appreciate it. Thanks especially to everybody who joined us. So we got a some really great questions, some of which were, pretty tough too, because we had some people with some knowledge joining, which was great. So thank you again for joining. I would really encourage you again to keep following some of the business owner bootcamp podcasts so that as we talk about other things that apply to business owners besides QSBS, you get the benefit of that. I'm somewhat biased there, maybe as one of the hosts of that podcast, but we've had great people like Liz and Kevin on, and we'll have more great people. We hope you join us there. Keep following our written content on social media and on our website. We'll have more good stuff there. But I hope you gathered that QSBS is incredibly powerful. It's something that if you start early, you can really unlock huge tax savings. And as we say, it's underappreciated, underutilized, but it fits well with the estate planning that we want to do anyway for people, because there are those the chance to do conversions and other things to make everything work. So if you're a client and you have further questions that we didn't address, please reach out to your advisor. If you're not a client, we'd love for you to be a client. So ask us for a link. We'll figure out a time that works for you, and would be happy to talk more with you, and share some of this learning because we think it's fun. So thanks everybody, and goodbye.